Hello, I'm Ed, the business rescue expert. I'm going to answer some of your questions about MVLs, also known as Members Voluntary Liquidations. An MVL is when directors and shareholders of a solvent company close it down to release the surplus cash and assets in a tax-efficient way. If it is done correctly, each individual shareholder will be able to claim entrepreneur's relief on their tax returns, making it a highly advantageous way of paying final profits to yourself. For an MVL to be cost-effective, the company needs to have surplus assets of over £20,000 to distribute to its shareholders. An MVL is relatively inexpensive, generally costing less than £2,000, and can be done in as little as 10 working days or less, depending on the complexity. How does an MVL work? We have an initial virtual meeting with the board, where we go through the process and implications of an MVL to make sure everybody understands what's involved. We give a list of pointers to the directors so they can start to finalize the company's affairs. This means raising final invoices, paying immediate outstanding debts, and preparing final accounts and tax returns. A legal declaration of solvency is then sworn that sets out the company's remaining assets and liabilities and confirms that the company can pay off all debts within 12 months. Making a false declaration here is a criminal offence, so everything has to be accurate. A final directors and shareholders meeting is held to confirm the MVL. We then sell any remaining assets and distribute the proceeds to creditors, then shareholders, in that order. Once this is done and HMRC give final clearance, the company is formally dissolved. To gain the tax benefit, the company must comply with HMRC's Targeted Anti-Avoidance Rule, or TAR for short. This means that within 2 years of an MVL, company owners should not set up or have control of a business that carries out the same activities as the original business. If this rule is breached, HMRC can reclassify any MVL distribution payments as income, and the higher level of tax will be retrospectively applied, including any interest as well. So in summary, MVLs are tax efficient and easy to implement. They allow shareholders to pay entrepreneur's relief on their final profit distributions at 10% rather than the higher rates. However, before starting the process, it's important to get proper advice, otherwise you can fall foul of HMRC's anti-avoidance rules. Contact Business Rescue Expert to find out more. Let the Business Rescue Experts help you help yourself.